Hello, everyone. My name is Brian McSwain, and welcome to Corporate Finance and Advanced Analysis. This is prepared for finance theory and research. Let's begin. Corporate finance is a field that focuses on the financial activities related to managing a corporation. This includes decisions about capital investment, financing, and returning capital to shareholders. Traditional topics in corporate finance are widely known and covered in introductory courses and textbooks. However, this presentation aims to go beyond the basics and explore advanced topics that provide deeper insights and practical applications for real-world scenarios. By understanding these advanced concepts, professionals can make more informed decisions that enhance shareholder value and ensure the long-term success of their organizations. Advanced capital budgeting techniques go beyond traditional methods such as net present value and internal rate of return. Two such advanced techniques are real options analysis and adjusted present value. Unlike traditional methods, real options analysis treats investment opportunities as options, providing a framework to value the flexibility and strategic choices available to managers. This technique is particularly useful in uncertain environments where future opportunities and managerial decisions can significantly impact the value of an investment. By evaluating these options, managers can make more informed decisions that better align with the dynamic nature of business environments. Adjusted present value, or APV for short, separates the value of an investment project into two components. The first being the base case net present value, which assumes all equity financing, and the second being the value of the financing effects such as tax shields and subsidies. This separation allows for a more precise analysis of how different financing structures impact the overall value of a project. It builds on the foundational principles laid out, emphasizing the importance of considering financing effects in investment decisions. Moving forward, we will explore the optimization of capital structure, which is fundamental for maximizing a firm's value. We will take a look at three key theories: the trade-off theory, the pecking order theory, and the market timing theory. First, let's take a look at the trade-off theory. This theory suggests that firms seek to balance the tax benefits of debt with the potential costs of financial distress. According to Krauss and Litzenberger, the optimal capital structure is achieved when the marginal benefit of debt, primarily tax shields, equals the marginal cost of financial distress, such as bankruptcy costs. This balancing act helps firms maximize their value by optimizing their debt levels. The second theory is the pecking order theory. Proposed by Myers and Magaluf, this theory postulates that firms prefer to finance new projects using internal funds first, then debt, and issue new equity only as a last resort. The rationale behind this hierarchy is the presence of asymmetric information between managers and investors, which can make external financing, particularly equity, more costly and less desirable. Finally, we look at the market timing theory. This was introduced by Baker and Wergler in 2002. This theory argues that firms time their financing decisions based on market conditions. Essentially, firms issue equity when their stock prices are high and repurchase shares when prices are low. This strategic timing allows firms to optimize their capital structure by taking advantage of favorable market conditions. Each of these theories offers a unique perspective on how firms can structure their financing to achieve optimal results. Moving on, let's look at the dividend policy, which is a critical component of corporate finance that affects both investor satisfaction and the overall valuation of a company. We will discuss two significant theories: the residual theory and the dividend irrelevance theory. First, we have the residual theory. According to this theory, dividends should be paid from the residual or leftover equity only after all acceptable investment opportunities have been financed. In other words, firms should retain earnings to fund new projects that have a positive net present value and pay dividends only if there are excess earnings left after all these projects have been financed. This approach ensures that a company maximizes its growth potential before returning capital to shareholders. Next, we consider the dividend irrelevance theory. This theory postulates that in a perfect market, the firm's value is determined solely by its ability to generate earnings and its investment policy, not by how it distributes dividends. According to this theory, investors are indifferent to receiving dividends or capital gains, assuming there are no taxes, transaction costs, or information asymmetry. In essence, the dividend policy does not affect the value of the firm. Both of these theories provide valuable insights into how firms might approach dividend payments. While the residual theory emphasizes the importance of funding growth opportunities first, the dividend irrelevance theory highlights the idea that in perfect market conditions, dividend policy might not impact a firm's value. Mergers and acquisitions, or M&A for short, are significant activities within corporate finance that can fundamentally transform companies. We will explore the different types of mergers and acquisitions and the key factors that contribute to their success. First, horizontal mergers involve companies operating within the same industry. These mergers are typically aimed at achieving economies of scale, reducing competition, or increasing market share. For example, two tech companies merging to consolidate their market position. Vertical mergers occur between companies at different stages of the supply chain. These mergers aim to increase efficiency, reduce costs, or improve supply chain management. An example would be a car manufacturer merging with a parts supplier. Conglomerate mergers involve companies in unrelated businesses. These mergers are often pursued to diversify risk or enter new markets. For instance, a food company merging with a tech firm. For mergers and acquisitions to be successful, several critical factors must be considered. The first being the alignment of the merging company's goals, cultures, and strategies. A strong strategic fit ensures that both companies can work together effectively towards common objectives. Next, comprehensive due diligence is essential. It involves thoroughly assessing the target company's financials, operations, and potential risks. This step ensures that the acquiring company fully understands what it is purchasing and can mitigate any risks. Lastly, effective post-merger integration is vital for realizing the anticipated synergies and achieving the strategic objectives of the merger. This involves careful planning and execution to combine the operations, cultures, and systems of the merging companies seamlessly. Understanding these factors can help companies navigate the complex process of mergers and acquisitions and achieve successful outcomes. Let's now discuss the critical topic of corporate governance and ethics in finance. Corporate governance refers to the system of rules, practices, and processes by which a firm is directed and controlled. Good corporate governance is vital for maintaining investor confidence, improving financial performance, and reducing risk. Effective corporate governance frameworks ensure accountability, fairness, and transparency in a company's relationship with its stakeholders. These frameworks promote better decision-making, improved operational performance, and enhanced investor confidence. Companies with strong governance practices are often more successful and resilient in the long run. Ethics in corporate finance involves conducting business in a manner that is fair and ethical. This includes ensuring transparency in financial reporting, avoiding conflicts of interest, and adhering to legal and regulatory standards. Ethical behavior is crucial for maintaining trust and integrity in financial markets. When companies uphold high ethical standards, they foster a culture of trust and reliability that benefits all stakeholders. Let's take a look at how behavioral finance influences corporate decision making. Behavioral finance examines the effects of psychological, social, cognitive, and emotional factors on the financial decisions of individuals and institutions. Understanding these behavioral biases is crucial for improving corporate decision making. First, let's discuss overconfidence. Overconfidence bias occurs when individuals overestimate their knowledge, abilities, and the precision of their information. This can lead to excessive risk-taking and suboptimal investment decisions. For example, overconfident managers might overinvest in projects with negative expected values, assuming they can achieve better outcomes than what is realistically possible. Herd behavior describes how individuals in a group can act collectively without centralized direction. This behavior can result in stock market bubbles and crashes as investors follow the actions of others rather than making independent decisions. Herd behavior can also impact corporate decisions, such as firms following industry trends without thorough analysis. Loss aversion refers to the tendency for individuals to prefer avoiding losses rather than acquiring equivalent gains. This bias can lead to holding on to losing investments too long and selling winning investments too quickly. Managers influenced by loss aversion might avoid necessary but painful decisions, such as cutting unprofitable projects. Behavioral biases can significantly impact corporate finance decisions, leading to suboptimal capital budgeting, financing, and investment strategies. For example, overconfident managers might pursue aggressive growth strategies that are not financially viable, while herd behavior might cause firms to invest in popular but risky industries without proper due diligence. To mitigate the impact of these biases, companies can implement two key strategies. The first being education. Training and educating managers and employees about behavioral biases can help them recognize and mitigate these biases in their decision-making processes. Next, structured decision-making processes. Implementing structured decision-making processes such as checklists and formal approval procedures can help reduce the impact of biases by ensuring decisions are based on rigorous analysis and objective criteria. These processes provide a systematic approach to evaluating options and making decisions, thereby minimizing the influence of biases. Understanding and addressing behavioral biases is essential for making sound corporate financial decisions. Integrating sustainability into financial decision-making can lead to better long-term outcomes for companies and their stakeholders. Sustainability in corporate finance involves considering the long-term environmental, social, and governance, or ESG, impacts of financial decisions. Sustainable finance aims to align financial activities with sustainable development goals, ensuring that business operations do not harm the environment or society and contribute positively to the global economy. ESG factors have a significant impact on corporate performance and investor decisions. Companies that effectively manage ESG risks and opportunities tend to perform better financially over the long term. Research performed in 2015 shows that integrating ESG factors into investment decisions can lead to superior financial performance. ESG considerations help companies manage regulatory risks, improve operational efficiency, and enhance their reputation. In conclusion, this presentation has covered several advanced topics in corporate finance, including advanced capital budgeting techniques, capital structure optimization, dividend policy, mergers and acquisitions, corporate governance and ethics, behavioral finance, risk management, and sustainability. By expanding upon these areas, we have explored the complexities and strategic considerations that go beyond basic corporate finance principles. Continuous learning and staying informed about the latest developments in these areas are essential for making informed financial decisions and achieving long-term success. Thank you.